Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Mark Gleason, Managing Director and Head of America's Multi-Asset Business Development at Bernstein. He joins me to discuss buffered products and how advisors view the structure. Mark, it is great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Thanks for having me.
You got it. Let's define a buffered product and why are they used today? How are advisors approaching them?
Sure. Yeah, we think it's important to define them. They've clearly become popular, but maybe aren't in everybody's vocabulary from an asset allocation perspective. So at a highest level, a buffered product is an option-based strategy that offers upside participation, usually on an equity index, think the S&P 500, up into a defined cap, and then a large amount of downside protection versus a loss via the buffer, hence the buffered product. So clients are using that structure in a number of ways. You could be a client who's concerned about near-term market volatility, wants to participate in equity markets, but also wants a level of protection. You could have a near-term funding requirement where, again, you want some market growth, but want to make sure you're protected against any significant losses. And then if you just take a step back and look at what these strategies are trying to achieve from a risk-return perspective, they're mid-high single-digit returns, they're very defensive, they're very lowly correlated to stocks and bonds. We think that that structure is something that clients can find a lot of utility in, regardless of their sort of general outcome. And if you look at the market backdrop, that's clearly the case that advisors are finding more and more use for these in their clients' portfolios. In 2013, there was $10 billion in net assets in these strategies. Today, that's over $73 billion. So it's clearly something that advisors are gravitating to, and we think that makes sense.
And Mark, there's a lot of competitive products in the marketplace today. What sets the Bernstein offering apart?
Yeah, so again, I think it's helpful to step back. If you look at specifically the ETF universe that we compete against, a large amount of client assets are in what we call sort of a vintage-based approach, where a ETF sponsor is using usually a 12-month structure of the options. They launch a new ETF every month, and clients sort of buy them as they see fit. One of the things that we think makes our offering BUFC very attractive is all options trading occurs within the strategy. So this is an evergreen strategy. You can buy it once and insert it in a client portfolio and be confident that we're managing the option exposure for you. And again, versus most of those competitive products where the term of the options is 12 months, BUFC is actually using a 3-month option term. So if you think about if I'm offering you 15% of downside protection over a 12-month period or a 3-month period, the 3-month structure is obviously going to be much more defensive. And because of that, we actually think that we sort of fill a different part of kind of the risk return universe as something that's going to be more defensive than a lot of other competitive products out there. And then finally, like most things at Bernstein, we're employing our own proprietary tools within BUFC, really to try to maximize that upside potential without sacrificing that downside protection.
And finally, how are clients using the strategy?
So we've seen a lot of client use cases. I would say on sort of the more traditional side, we've seen clients source it from their U.S. equity portfolio to sort of add a flavor of risk management to an overall asset allocation. Again, while still participating to a degree in equity markets. We've also seen clients source it from fixed income portfolios to kind of maintain their normal risk return, but really lower their interest rate exposure. And then finally, like we talked to at the start, because of the characteristics of these strategies, we've also had clients that sort of just view it as a liquid alternative, and will put it alongside a number of different alternative strategies that they're deploying within their own portfolios. And again, the other big use case that we've seen because of the evergreen nature of BUFC and the strategy that we've developed is that we think we've built something that's much more user-friendly from sort of an advisor model perspective. So the majority of the assets that we actually manage today are from clients that like buffered structures, like these products, but find sort of the normal vintage-based approach is kind of clunky in their use case, and find something like BUFC much easier to slot into a model as something that they can own over time.
All right, Mark, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.